Collar option strategy, limiting your risk while staying bullish. So a collar option strategy is used to limit the returns of an underlying long position to a specific range. Typically, investors use the option collar to hedge an underlying long position against downside volatility and at the same time guarantee an exit if the market goes higher. This is achieved by buying a protective put option and simultaneously selling a covered call to finance the cost of the put. One way to think of the collar option strategy is it works the same way as placing both a stop loss and a take profit order against the underlying asset. By using the strategies, investors limit both the potential upside and potential downside associated with holding the underlying asset. Strategy setup. The first step in the collar option strategy is selecting which strike prices align with your market view. Let's assume an investor holds 1.0 BTC, which is currently trading at $20,000, and wants to hedge against a drop below $18,000 in the next 2 months. They may do something like this: buy 1.0 BTC 18,000 put option with 60 days to expiration. The buyer pays a premium of $1,000 to offset the cost of the put. The investor then sells a covered call option. The call option is usually, although not always, for the same amount of underlying and with the same expiration date. The investor sells 1.0 BTC $22,000 call option with 60 days to expiration, receiving a premium of $1,000. So here the cost of the trade is 0,000 premium paid minus 1,000 premium received. Depending on market conditions and the selected strikes, a collar option may be traded at zero cost dollar, a net credit, which is premium received, which is greater than premium paid, or a net debit, which is premium received, which is lesser than premium paid. So the cost of the strategy varies depending on the distance of the strike prices to the underlying asset. So typically, a collar position involves strikes of equal distance to the underlying asset. Here, the premium should be held equal or close to equal value, which is delta neutral or delta minus neutral. So the delta is a calculation used to determine how much an option premium changes in value for each $1 move in the underlying asset. So call options have a positive delta ranging from 0 to 1, and puts have a negative delta ranging from -1 to 0. And the money options typically have deltas of 0.5 over -0.5, reflecting the equal odds of expiring either in or out of the money. Call delta increases as the market moves higher, and put delta increases as the market moves lower. Understanding delta helps to explain the mechanics of the options collar. If the underlying asset falls, the value of the long put increases at an ever faster rate, helping to offset the loss in the underlying. If at expiration the underlying asset is below the strike price, the put delta is -1.0, meaning the value of the put increases at the same rate the underlying falls. Here the put perfectly hedges the difference between the strike price and the option settlement price. By contrast, if the underlying moves higher towards the call option strike price, the premium of the short call increases. Similarly, if at expiry the underlying asset is above the strike price, the option delta is 1.0. Here the losses incurred from the short put will offset the underlying gains 1:1 above the strike price. The key difference is that for the short out of the money call to expire in the money, the underlying will be higher than when the trade was initiated. So call option strategy, how it works. So the call option strategy combines the protective put and the covered call strategy. As such, it can be used as an alternative to both. Combining the two strategies has benefits and limitations. To understand the potential payout and the risk of a particular option strategy, option traders use payoff diagrams. The below payoff diagram represents a long position in an underlying asset, like a stock or BTC. The black line is the price moving higher, left to right, and the blue line shows the profit and loss as the market moves away from the purchase price. So here there are three outcomes. 1. The market has no movement and the asset value remains the same. 2. The position makes money when the market moves higher. 3. The underlying asset loses money when the market falls. So here's a long underlying asset payoff diagram. Option collar versus covered calls. So the main advantage of using the options collar as opposed to a covered call strategy is the collar's protective put hedges against a drop in the underlying. The below payoff diagram shows that when used in isolation, the covered call has limited potential profit and a significant downside. The premium received minus the difference between the underlying asset price and zero. So the covered call payoff diagram. Whereas the collar strategy limits the maximum potential loss. Here's a cover strategy payoff diagram. Option collar versus protective put. So adding the covered call to the protective put helps cover the cost of the out option. However, it also caps the upside profit potential if the short call expires in the money. So an option is considered in the money if the underlying price is above the strike price, which is the calls, or below the strike price, which is puts. Here there's an immediate benefit in exercising the options. So any strike price in an unprofitable position relative to the underlying is referred to as out of the money. For puts, there's a strike price below the current market price. For calls, is any strike price above the current market price. Lastly, a strike price equal to the underlying asset price is called at the money. So the long put, when used alone, protects against potential downside without limiting the potential profit. The maximum loss is limited to the purchase price of the option. So long put payoff diagram. So who is a collar option strategy for? The collar is a simple option strategy with limited risk and thus suitable for investors of all knowledge levels. However, to get to the best from this play, it's advisable to select the strike prices that match your investment objectives. Reverse collar option strategy. As the name suggests, the reverse collar option involves doing the opposite of the traditional collar strategy. The reverse collar is used to limit an underlying short position to a specific trading range. Instead of writing covered calls and buying puts, an investor with a short position sells covered puts and buys protective calls. However, the long call hedges the short position and the short put limits the maximum profit potential. The reverse collar is widely used in commodity markets, where it is referred to as a producer hedge. Community producers use the strategy to lock in both the best case and worst case price levels to exit the underlying short position. Also is future production. When to use the collar option strategy. So because the covered call works against the underlying asset in a rising market, the collar option is best deployed when an investor is worried about near-term weakness. The advantage of using a collar option as opposed to placing a stop and limit order against the underlying is its versatility. When the collar strategy, the underlying asset could trade below the long put strike price, whilst the contract is active but turns higher before the expiration date. So here the protective put works perfectly, allowing the investor to weather near-term volatility but crucially keep their long-term long underlying position. Break-even point. So assuming the cost of entering the trade is 0, premium is equal to premium received, the break-even point at the expiration is the same price as when the trade was entered. So because the corresponding premiums offset each other, the underlying price determines the break-even point. If the cost of the strategy is a net debit, the underlying asset must rise equal to that amount to offset the cost, whereas for a net credit, the break-even point is the price at which the underlying falls equal to the received credit. Sweet spot. The sweet spot for the collar option is when the underlying asset settles equal to the short call strike. Here the short call is at the money and expires worthless, and the investor keeps the gains generated from the underlying asset price appreciation. Adjustment to make in bearish markets. So because options are flexible, investors can adjust their position to reflect a changing view of the market. However, doing so can impact the max profit and loss potential. Because the option collar offers downside protection, investors are unlikely to make adjustments in bearish markets. Instead, they less examine ways to adjust for bullish price action. So mildly bullish, medium risk. If the market moves lower towards or below the put strike and the investor believes the price will soon turn higher, they can sell a further out of the money put option to generate an extra premium. Doing this transforms the standalone protective put into a bull put spread. Although this play generates additional income, it also limits the hedge to the difference between the higher and lower strike. Bullish low risk. Either close both the put and call or buy back only the short call, leaving the protective put open. Whilst this increases the overall cost, it changes the strategy to low risk with unlimited upside. Bullish high risk. Selling a put option at the strike price as the short call effectively creates a synthetic long position, because the short put will be deep in the money, generates a hefty premium. Furthermore, due to put call parity, should the market rise, the short put will lose value at the same rate as the short call, effectively doubling the exposure to the underlying asset. Maximum take profit potential. So the maximum take profit potential is the same as the sweet spot. If the underlying asset is equal to the short call strike price at expiry, the call option expires worthless and the investor profits from the underlying appreciation. Maximum incurred loss potential. So the maximum incurred loss potential when using the collar strategy is if the underlying asset is below the long put strike price at the expiration date. Here, the maximum loss is the difference between the price of the underlying asset at the time of trade and the strike price of the put option, plus or minus the net cost of the trade. Collar option strategy example. The below example shows how an investor holding an underlying long stock position in Amazon, totaling 100 shares, could use a collar option to protect against potential price volatility in the underlying security surrounding an approaching earnings call. To underline Amazon stock price of $135, the investor purchased one contract with 100 shares of the Amazon $125 put option, paying a premium of $12 per share, which is $1,200. The investor then sells one contract, 100 shares of the Amazon $145 call option, with the same expiration month, receiving a premium of $11.50, which is $1,150. The cost of the trade is a net debit of $50. Premium received minus premium paid multiplied by option multiplier of 100 shares. To here, the investor's downside risk is protected if the underlying stock price falls below $125, with a guaranteed sale price of $145 if the short call option expires in the money. With just a few simple steps, crypto traders can use Bybit USDC settled options to deploy the collar strategy to protect the underlying crypto holdings. So step 1, log into Bybit trading account and under derivatives select USDC options. Step 2, select the desired expiration date or view all the available expiration dates at the same time. Step 3, select the strike price you wish to trade. All options are shown on the left hand side of the option chain and puts on the right. So step 4, with the strike now selected, another placement ticket appears. Here you'll find the grid calculations, the recent trades and the market depth. By scrolling down, you can view the payoff diagram for the selected option. Step 5, the margin required is calculated and displayed at the bottom of the order ticket once you have chosen your order size and direction, buy or sell. Then you click place order if you want to continue. As you can see here. Step 6, repeat the process for the remaining strike, either put or call, to complete the options collar strategy. Collar option strategy tips. So select the strike prices that reflect your view on the underlying asset price. Choose option contracts with expiration dates that fit your objectives. Remember to factor the cost of the strategy, either net credit or net debit, into the break-even price calculation. Margin requirements. Accounts with the minimum net equity of 1,000 USDC can take advantage of lower margin requirements and higher leverage by signing up for portfolio margin mode. The portfolio margin mode uses a risk-based margin policy designed to reduce margin requirements for hedged portfolios. It does this by offsetting the exposure of long and short options positions against each other, because the underlying asset in the collar option hedges the option strikes. Portfolio margin mode reduces the margin requirement for the strategy significantly. Theta decay impact. Theta decay or time decay has minimal effect on this strategy. Both the put and call premiums will erode over time due to the effects of time decay, although an option sensitivity to time decay changes depending on how close it is to the underlying. The time value of both options is 0 at the expiration date. Here, the time value loss on the long put is offset by the gain in the short call. Implied volatility effect. Implied volatility has a limited overall effect on the collar option strategy. All things being equal, option premium rises when IV increases. In this strategy, a linear expansion in IV is offset by the opposing long and short positions. However, one thing to consider is that the more volatile the market is, the greater chance one of the strikes with expires in the money. To benefit, protect against near-term weakness. Max loss and max profit are known at inception. Cons: the strategy has limited profit potential. It caps the upside of the underlying asset. Risks: the biggest risk when using the options collar is missed opportunity. This particular strategy is unfavorable if the underlying asset moves much higher. Here, alternative strategies would be more effective. Alternative strategies: investors usually deploy the option collar when unsure of the underlying near-term direction. However, alternative strategies can offer similar downside protection profit with greater upside potential. To long strangle, buy at the money put and at the money call with the same expiration dates. Bull put spread, buy and at the money or out of the money put and sell a further out of the money put. Protective put, buy a stand-alone put option. Conclusion: the option collar strategy is a great way to hedge a long-term holding, although selling the call limits the upside profit potential. The protective put reduces the downside risk of your crypto asset. Because of its simplicity, the strategy offers an effective low-cost way for the less experienced options trader to protect against market volatility.